So as we come towards the end of our financial management curriculum, we now pick up some of the advanced topics and topics which kind of are a combination of all that we have done so far. We start Unit 5 with the first discussion on a little bit around the issues with NPV and IRR in the real world, right? So while these are rules that we have read that if NPV is greater than 0, then accept a project, else reject a project. If your IRR is essentially greater than the cost of capital for a project, the discount rate for a project, then accept a project. These are rules that we have kind of read through, but there are some interesting nuances that come up when we discuss something like NPV and IRR. And that's what is the crux of this particular discussion that we are having here. So we start with that, then we do an introduction to capital budgeting during this section, understand how do we introduce cost of capital and some other nuances with calculation of cost of equity, etc. And then other issues with respect to capital budgeting that follow. This section is going to talk about issues with NPV and IRR. The issues with NPV are relatively simpler to understand. Right, there are a couple of issues with NPV and we should be able to kind of comprehend them straightforward. IRR is a little bit more tricky and in real world does create a little bit of a discrepancy when you see managers in firms kind of taking actions on the financial management front. Sometimes not applying these rules correctly. So it's important to understand them from a conceptual framework and understand what are the limitations of some of these rules as they exist. And then we kind of take it ahead in terms of our overall understanding of both NPV and IRR, right? Let's begin with the NPV issues first. And when you look at the NPV issues, that's the issue 1, right? So companies do take multiple projects, right? So there's a project 1, there's a project 2. And let's say there's a project 1 which has a positive NPV, but a project 2 which has a negative NPV. Now, a manager might just decide that overall, which is nothing but project 1 plus project 2, both the projects 1 and project 2 is going to be positive because on the whole, the company is making money. Now, just because overall NPV is positive, the manager may take a project which should otherwise have been rejected. Think about it this way. If you added the cash flow from project 1 to the cash flow from project 2, then you might get the overall cash flow. And when you calculate this, NPV will appear to be positive, right? So you might take it. So for example, there could be 2 projects. Project 1 says expansion of the plant in one location, and project 2 is expansion of the plant in another location. So there are 2 different expansions that's being taken care of. So let's say there's an expansion in Chennai and there's another expansion in Mumbai. And one of them is NPV positive, one of them is NPV negative. But when you combine and evaluate, both of them are positive. They add up to positive. Now, in real world, ideally, the second expansion, which is negative, should be rejected. But because people combine and look at decisions, it is fairly possible that they end up accepting the overall project in the whole, which is a combination of project 1 and project 2. So it is important as a remedy to look at specific projects. So check specific project NPV to see what project should be accepted and what should be rejected. You can't look at a combination of multiple projects. Whenever you can break down it into smaller projects, which are kind of, it's possible to kind of take one way or the other, then you should try and break it down into multiple smaller sub-projects and find out the NPV of each of them. If it is positive, accept. If not, find an alternative to that, right? That's the first issue with NPV. The second issue with NPV is if you look at these projects, project 1, 2, 3, right now, some of them so for example, project 1 and project 3 both have a positive NPV. If you look at just the NPV rule, you should accept project 1 in this case. But because there are issues with with financial managers, people look at what is the payback period. Payback period is when are you getting your money back. Now for project 3, you're going to recover your money back in 2 years. For project 1, you're going to take 3 years for that, right? Now in such a situation, what happens is sometimes managers look short term, and managers would look at the short term, and they would tend to believe that, earlier we get the money, earlier money is better, right? And that could be because, let's take a scenario where capital is constrained, right? Capital is constrained would mean capital is scarce. You have limited capital. Now, sometimes in this case, the manager might believe that if you get your money back faster, like in project 3, if you get your money back faster, you can redeploy that money in another project, right? That obviously assumes that there is a constraint on capital. You don't have adequate capital available. However, if it's a large firm, let's say it's a large firm like Reliance Industries, in that case, there isn't really any constraint on capital. They will get whatever capital they want, either from the share market or from the banks. In those cases, you should be trying to maximize the NPV, regardless of what the payback period is. That doesn't matter. But in real world, because managers will look at short term, not just because they might want to get capital early, sometimes it's just that the incentive structure is such that the faster you get the money, the better it is. Let's say there is a manager retiring after 2 years, right? So if the manager retires after 2 years, in this case, just because the manager is retiring after 2 years, he would want to show that the performance was great in his tenure, in which case he would want to get the payback within 2 years, not in the third year, because someone else might get the credit for this huge payout in the third year. So sometimes behavioral issues create a problem, sometimes constraints on capital create a problem. In itself, we should be selecting project 1, but in real life, a lot of the times you will see the issues such as this, where if payback period is faster, a project is selected on account of payback period and not necessarily because its NPV is higher. So that becomes an important parameter to consider whenever you are kind of looking at NPV issues as well. Right. Let's then move ahead. These are the specific NPV issues, and I said these are slightly simpler to kind of comprehend. But the IRR issues go a little bit further in terms of getting our understanding. So let's look at this case 1 in the context of IRR issues. Now, the first one of these IRR issues says that there are 2 projects, project 1 and project 2. If you see the cash flows, only the sign is different. So in the first case, you have minus 1,000 and plus 1,500. In the second case, you have plus 1,000 and minus 1,500. Mathematically, the IRR will be same. So this will be same in both the cases, right? That's because you are trying to find out at what value NPV will be 0. But if you look at NPV at 10%, you find NPV is opposite sign, right? So in one case, it is positive, in one case, it is negative. So IRR says you can take any decision, but NPV says choose one and not choose 2. So what is it that you would choose in this particular case? Now, if you think about this closely, what is project 2? You are getting 1,000 and you are paying out 1,500 in the end of the first year. You're getting 1,000 now and you're paying out 1,500 at the end of the first year. In other words, project 2 is nothing but borrowing 1,000 at 50%. You're getting 1,000 today at 50% and you have to pay 1,500 1 year down the line, correct? So you're borrowing 1,000 rupees at 1,000 crore at 50%. The project 1, on the other hand, you are giving out 1,000 today and you're getting 1,500. In other words, you are lending 1,000 at 50%. Now, which one should you choose, right? So logically, in the case, you would want to lend at 50% because your cost of capital is 10%. As long as you're getting more than what your cost of capital is, you will keep raising money at 10% and keep lending it out at 50%. You'll always do that, right? So logically, we should accept project 1. IRR, however, if you just calculate IRR, they look like similar projects. And that is where the first issue with IRR rule comes in. If you find that two projects are equally attractive on the basis of the IRR rule, it possibly makes sense to go one step further and calculate NPV, right? This is a very simple, stark example where we can find that NPV rule trumps over the IRR. So if there is a doubt, use NPV. NPV in doubt, right? Use NPV in case of any doubt in the IRR rule. So that's our first premise that we kind of establish in this particular case. The first case is of lending at 50%. The second case is of borrowing at 50%, and lending should be our choice. And NPV rule shows that lending should be our choice, right? That's the first issue with IRR. Let's look at another issue with IRR. Now, if you look at this stream of cash flows and you try and find IRR using Excel, or you try and find out where, the rate at which NPV becomes 0, mathematically, in this case, there are two IRRs that exist. You discount this entire thing at 3.5% or 19.5%. At both rates, you will get IRR equal to NPV equal to 0. Now that's funny because this does exist in real world. As a rule of thumb that you'd see, you look for sign changes in cash flows, right? In usual conventional cash flows, there is a negative cash flow, and then there are positive cash flows, positive cash flows, positive cash flows. Here there is a negative cash flow and you start having positive cash flows. So this is one sign change, that's sign change 1. And in this particular case, at the end, there is another sign change. So that's sign change 2. Typically, whatever is the number of sign changes in the cash flows, positive becoming negative or negative becoming positive, you can have up to that many IRRs. So if there are 3 sign changes, then you can have up to 3 IRRs, right? Now that's interesting because that does convolute the logic of what do we expect and how do we, at what levels do we accept the project. If you actually look at plotting the NPV IRR curve, if this is the rate and this is NPV, you will note that the curve will probably appear something like this, where the first point is 3.5% and the second point is 19.4%. NPV is positive in all rates between 3.5% and 19.54%. So as long as you have a scenario that your cost of capital is between 3.5 and 19.54, you accept the project. In these cases where you have multiple IRRs, it is always useful to be able to draw this kind of a plot. Remember, we had seen a plot where we can basically look at what is going to be the present value of the particular project at various discount rates. Just plot it on a curve and you will see how many IRRs are there. And based on that, you can define whether you accept the project, which is going to be in this zone, or you reject the project at any rates below 3.5 and any rates above 19.54. Now, these are unconventional cash flows because in real life, you don't find too many such projects, but there could be projects in real life where you require multiple capital outlays. So you invest, let's say 300 crore. Today you get 100, you get 100, then you invest another 100 somewhere and then you get 500 and you get 600. Look at the number of sign changes. That's 1 change, that's 2 change, and that's 3 change. This kind of a project can have up to 3 IRRs. It is not necessary that it has 3 IRRs always. It can have up to 3 IRRs, and that is where the decision point becomes tricky for us when we are looking at the IRR rule. So just remember at our end that if there are unconventional cash flow streams where you have multiple sign changes, what is a conventional cash flow stream? Where negative is followed by positive always, right? Your initial outlay followed by always some sort of an inflow that is occurring for the firm. Those are conventional cash flows that you typically would see, right? So that's your discussion on the second issue with NPV. Now with IRR, the third issue with IRR is there are some projects where the IRR doesn't exist at all rates. NPV is positive, right? Now these are some projects that are kind of too good to be true. That's like free money available to be made, riskless kind of projects. If you were to plot a curve between NPV and the rate, you would probably get a curve like this, which is like positive at all IRRs, right? So effective at all rates. So effectively, this project has to be always accepted. On the other hand, you could also find a project which is kind of negative NPV at all kind of discount rates. That kind of project has to be always rejected. There's no way you can make money on a project sometimes, right? So in those cases, you have to kind of reject your projects that are essentially going to be NPV negative at all points of time. So in certain kind of projects, you find that the issue with the IRR rule is that the IRR doesn't exist, right? And that creates a little bit of a problem if you were using the IRR rule to try and find out what project should be accepted, right? So in all these cases, whenever you're in doubt, you should be following the NPV rule as your primary rule in terms of discussions, right? Let's move ahead and look at one of the final issues with IRR, which is a tricky issue that comes up. Now, so far, the discussion was straightforward in the sense that one said reject a project, the second said accept a project. What happens if both the rules, IRR and NPV, end up telling you to accept the project? If both rules end up telling you to accept the project, in that case, what do you do? What is your answer going to be in that particular discussion? So let's look at two projects, project 1 and project 2. And you look at project 1, which says IRR is positive at 100% and NPV is also positive. So technically this project should be accepted. And let's say you look at project 2, IRR is 75% and at NPV at 10%, this should also be accepted because both rules are being met. IRR greater than cost of capital and NPV greater than 0. What happens if you have to choose only one project, which is essentially saying that you want to look at mutually exclusive projects? You choose only one. Now what do you choose? IRR says project 1 should be chosen. NPV says project 2 should be chosen. Now, standard rule in these cases is look at what adds more value to the overall company firm, assuming that of course there is no constraint on capital. Once again, if there is constraint on capital, for example, there is a constraint which says that using 10,000 is better than using 20,000 today because there is a stretch that you will have to do to get this 20,000, or there are some other costs that are involved in getting this 20,000, then you use project 1. But if there is no constraint on capital, then you should use the NPV rule in case of conflict. In case of conflict, right? The other thing you can do is, in this particular case, let's assume you choose project 1 and you leave project 2, right? You want to find out, so project 1 has to be chosen, that's clear, that's fairly clear. Now let's assume that you're trying to find out the incremental value that project 2 adds, right? How do you find incremental value that project 2 adds? I need to find out the cash flows of project 2 minus project 1. That's the incremental value that the project 2 adds. Can I do that? Can I find those cash flows? Those are the cash flows. So this is nothing but project 2 minus project 1. That's what we have done. So minus 20,000. So incrementally, if you are taking project 2, what do you have to do? You have to spend an extra 10,000 and you get an extra 15,000, right? So you put an extra 10,000 and you get an extra 15,000. What is the IRR of this set of cash flows? That's at 50%. more importantly, what is the NPV of this set of cash flows? That's positive. So it makes sense to do this incremental investment, right? It makes sense to do the incremental investment because the IRR is greater than your cost of capital, right? 50% of IRR is greater than 10%, which is at what you are raising money and you're kind of defining it. And NPV is positive. So in the first instance, let's say you choose project one and you do this and you get all this money, it makes sense to raise this extra 10,000, instead leave project one and invest in project two, because this extra money that you're raising is going to eventually give you an extra amount that comes out, right? It's like, again, if you go back to that example, you're lending about 10,000 to get 15,000, and that's your 50% rate of return that you're making on this extra investment. So going back to our idea is that you should be choosing project two, not only because you should use this rule whenever in doubt or in case of a conflict in NPV and IRR, use NPV, but also because incremental cash flows, right? Incremental cash flows are NPV positive. NPV positive if you take project 2 instead of project 1. So whenever in doubt, just try and find out this incremental set of cash flows between two projects. And this will also solve your doubt on whether you should be taking project 1 or project 2. In real life, of course, there are a lot of other interesting issues that come up, like we discussed about the payback period issue while looking at NPV rule. And if there are some sort of capital constraints that come in for certain firms where there is a difficulty in terms of raising capital at a later point of time, and hence if you receive money earlier, there are decisions that might get prompted because of that. So there obviously decision making becomes a little bit more subjective, but in reality, ideally you should be taking a project based on the NPV rule at all points of time. That's the rule that should supersede all other rules in real life, right? So that's broadly it in this particular section. We leave with a question, which is explain briefly about the various issues with the NPV rule.